What is going on, guys? My name is JR, and we have FOMC coming out just around the corner. So I'm going to break it down, but this is going to be an overall really extensive video. So no matter when you're watching this, you should be able to find some value about how FOMC actually works, because in this video, we're going to break down why this meeting matters more than any election. So we're going to break that down. And then we're also going to take a look at what FOMC actually is, what it measures, and why it matters for markets. And then we're going to take a look at the anatomy of an FOMC meeting day. So what actually happens during the FOMC meeting day, how you can trade it, and look out for the moves. And then of course what the dot plot is, because this is one of the most important part of FOMC and of the central bank's projections is the dot plot, because a lot of people don't understand where the actual forecasts for economic data points come from. So I'm going to break this all down. We also have the 5 actual FOMC. We're going to break down some moments that actually move the markets with FOMC, and I can actually recall a couple of these. So we're going to go ahead and get into that as well. And we're going to start with, of course, why this meeting matters more than any election. And the reason why is because this is going to be the direct control of the cost of money, and it's going to also set projections for what investors are thinking later on. So if you have a savings account and you have your money in a savings account and you're getting paid a certain annual percentage yield, that might change based off of what the Federal Reserve is doing with interest rates, right? And that's why FOMC is going to matter for even regular people, but also if you're invested or if you are a trader, it's going to cause stock market swings and volatility in the market, because they're going to project expectations, they're going to come out and they're going to say things, and the market's going to react one way or another. So it's very important to keep your eye on this if you're an investor as well. Let's say you're looking for a job. If FOMC, if they're signaling more rate hikes, it might be a bad time to go look for a job or ask for a raise, because more rate hikes means that that's the Fed's job. They're going to slow down the economy. They're going to slow stimulation, which means less people are going to go out hiring. Less people are overall going to be buying stuff as well, which is just going to slow down the economy. Or on the other hand, if they're lowering interest rates and they're stimulating the economy, then it might be a great time to go ask for a raise, or a great time to go, leave your current position and go look for a better paying job, because that their businesses have more room to spend money because interest rates are going down. So that's a good time to go look for a job, right? Or for example, a mortgage rate. If you're going to go get a mortgage, keeping an eye on FOMC interest rates are going to be key. So you're not going to, if you should get an adjustable or whatever it might be. Now, obviously you can't predict it, you can't tell, but it's important to keep a close eye on, right? If you're going to choose to get a mortgage or something like that, right? So what actually is the FOMC? It's 19 people. They meet 8 times a year. And we actually, the next meeting, like I said, coming up relatively soon. But all they do is they look at economic events. They're going to break down what happened. So we'll actually get down to that right here. Day 1, they're going to take a look at economic events. They're going to take a look at every little data point. And the cool thing is they actually there's 12 Federal Reserve banks across the nation, like San Francisco, Dallas. I don't know where they all are located off the top of my head, but there's 12 around the nation. And so they'll actually pull data from all those regions, and they can tell, every little single data point. They have the data points for age groups, race groups, every single little data point they can look at, they'll take a look at, and they will determine what they should do. And then on day 2, they actually have a debate, right? It's a little debate that they have. I also want to break down something, because the Federal Reserve is not a government entity. They work for the power of the people. They are designed to be the lender of the last resort for banks and keep the monetary policy system in check, make sure that our currency doesn't get completely devalued, things like that, right? So they are in place for a reason. So I just kind of want to throw that out there just so you guys can kind of get a little bit of an understanding, because a lot of people think that it's a government entity, but it's really not. So they have a debate. They're going to talk. There's hawks versus doves. Quick edit, because I didn't really break down what a dove or a hawk is. So when I talk about a dove is just someone with a dovish monetary policy stance. They are in favor of lower rates and a looser monetary condition, because they are looking to focus on growing the economy with jobs, whatever it might be. We also have hawks. When I talk about hawks, it's someone with a hawkish monetary policy stance. They are in favor of tighter monetary condition, and they want higher rates because they're looking to fight inflation usually. So that's what it means when I'm talking about a dove versus a hawk. So back to the video. They're going to have a debate, right? What should happen and why. They'll look at economic data. Like I said, they'll pull the data from the 12 banks, and they're going to determine what should happen, and they have a vote. So by the actual FOMC day, by 12 p.m., they have the vote, and they are going to pull, what they think should happen based off that vote. So whether they should raise, cut, or not. And now what is the most important thing about this? Now I'm going to break this down because there's a CME Fed watch tool, and this is very closely watched by the markets. And why this matters is because if they go too far away from what the market is expecting, like let's say next meeting, for example, in 4 days, there's a 95% chance that the Federal Reserve is not going to cut rates. But if we see them come out and kind of massively change these projections, the reason why it's so bearish is because the Federal Reserve, right, it kind of ruins their credibility, right? They have credibility with this dot plot, with the numbers that they project. There's credibility in those, but they lose that credibility, and it's kind of like a snowball effect, right? So it's very important. They're going to vote on what should happen, but usually the market prices in what's going to happen way before, so it's not even that big of a deal. Like it's usually kind of expected what's going to happen based off of all the data points that already have came out. Now, if they don't do what's expected, that's where markets move. Like for example, right now we're expecting no change on the 28th. So just in a couple of days, they're expecting zero change in interest rates, at least a 95% chance. So if they come out and they decide to do something that's, super dovish, and they actually cut rates, it's going to move the markets. So it's important. Or let's say they, project for future rate cuts, because right now, even March is having an 85% chance of no change. So if this number goes up significantly, then that could also be really market moving, because the market's always trying to jump the gun and price things in, right? So, important stuff. And then we also have, obviously they're going to come out, they're going to vote, they're going to decide what's going to happen. And by 2 p.m., the statement gets released, and the market's kind of just digesting that. It's, like I said, it's pretty straightforward. They kind of already priced in what's going to happen. If anything is a little crazy, it'll, get priced into the market. But the biggest thing that the market is going to wait for is this 2:30 talk by Jerome Powell, where Jerome Powell comes out on the stage and he answers questions. And right now is Jerome Powell, but in a couple months they're changing him. His term is coming to an end, so it's going to be a new Fed chair. No one knows who it is yet, but there is going to be a new Fed chair later on in the year. So if you're watching this later in 2026, probably going to be someone else in the Federal Reserve. But besides the point, they're going to wait for the talker or the head of the Federal Reserve to come out and talk, where he's going to give his speech. And this is actually where a lot of the media outlets will come, and they will have questions for Jerome Powell, and they'll try to throw him curveballs so he can kind of give, decisions on what's going to happen for policy moving forward. And so it's really interesting to watch. This is kind of the most market moving aspect of FOMC. And of course, the days after. So this is important. I kind of want to throw this in here because days and weeks after, this can shape market narrative for a really long time, not just, the initial spike that happens, or the day of the move, or the week of the move. This can actually shape narrative for a really, really long time. So it's really important to keep a close eye on that. Now, of course, the dot plot as well. So the dot plot is really important because everyone wants to know, what these numbers are. Because here's the deal. Okay, they're going to give these dot plot numbers 4 times per year. And what these numbers are is their expectations for the data points that come out every single month. Like NFP, when it comes out and you see a forecasted number for NFP, that number is forecasted in the dot plot by the Federal Reserve. And so that's why it is important. The Federal Reserve gives their expectations for data points over the next 2 years. And, for example, you can see even on the CME Fed Watch tool, it's giving these expectations until 2027. And that's not a coincidence. That's because that's, where the Fed is projecting its data till. So, for example, you can see like dot plots will show expectations in GDP. They'll show expectations for jobs numbers and interest rates. And, if the dot plot changes expectations, that's what can move markets. Like if, the dot plots, if market is pricing in 5 rate cuts, then the dot plot comes in and shows that it's only pricing, or that the Fed's only pricing in 3, it's going to be major market moving, right? So it's really, really important. But next, I actually want to break down some real scenarios with you guys, because there's a couple good ones that I can pull up on the chart. So we're going to do that. Let me pull up my chart here. All right, cool. So let's go up and let's take a look at a couple real scenarios. I'm not going to take a look at 2015. I don't want to go back that far, but I do want to look at 2020 because this was a massive moment for markets. And if we take a look, that was actually last year. It's been 5 years since I've gone in the market. That's kind of crazy. I remember this big crash. I remember my English teacher telling me she sold out of her stocks. It was funny, but yeah. Anyway, so this was actually this was the COVID. I'm sure a lot of you guys can recall. But what happened was the Federal Reserve cut interest rates to 0. So they actually did a really big cut to stimulate the economy. And as you can see, when they cut the interest rates, the economy had a huge stimulation. They also came out with a $2 trillion spending package so the economy can kind of stimulate itself. So that's another thing that contributed to this huge uprise in stocks, especially after a massive crash. So that's one example when they cut interest rates super aggressively and caused the market to actually stabilize and support itself. Now that wasn't a healthy thing for markets, but they needed to do that. And then we also have 2022. So you can take a look. There was mega rate hikes. They hiked rates 0.75%. It was the largest hike since 1994 because inflation was so high. And I remember inflation being at 9%. And this happening. I remember that, like I said, there was 2 negative quarters that actually were in negative GDP. But it ended up not being that bad. So let's take a look at that 2022 time. And it was actually well priced in ahead of time. I remember that as well. So if you take a look, you can kind of see January 2022 is when the market kind of started heading down. And it didn't end until around June, which is actually when I think, if we take a look, yeah, that's when the hike happened. So what's funny is the market priced in that hike the whole time until June when it actually fucking happened. And then you can see we kind of started to stabilize a little bit based off of the Federal Reserve's projections. That's what mattered more. That's probably what carried more weight. So let's take a look at 2024 as well, because we have a pivot. This was the first rate cut in 4 years. So they hiked rates for a while. The economy was still very strong. So they were able to hike rates for a decent amount of time. They hiked them to 4.5%. And now, if we take a look, they're cutting again, and you can actually see, let's go to around September 2024, when they started cutting interest rates. You can kind of see the economy started to stabilize again as well. So that's pretty much all I have for you guys today. I hope that I was able to help someone out along the way. And I do have a free Discord linked in the description below where I break down real economic events live. So if you guys want that, just click the link in the description below. And yeah, I'll see you guys in the next video.